For years, China has been the darling of the global investment community. Its rapid economic growth promised high returns, enticing investors from every corner of the world. The allure of China's booming markets and the promise of exponential growth made it a magnet for global capital. However, the narrative of an unstoppable economic juggernaut is faltering. The once unshakable confidence in China's economic prowess is now being questioned. Recent trends suggest a chilling reality. Global investors are pulling back from China. The flow of foreign capital, once a torrent, has slowed to a trickle. This shift, driven by a confluence of factors, signals a potential turning point in global capital flows. Investors are reevaluating their strategies, looking for safer havens. The reasons for this waning confidence are complex and intertwined. It's not just one issue but a web of interconnected challenges. They range from the ongoing trade war with the United States to mounting internal economic challenges within China itself. The trade tensions have created an unpredictable environment, while internal issues like debt and slowing growth add to the uncertainty. This confluence of factors has created a climate of uncertainty, making investors think twice about parking their capital in the world's second-largest economy. The once clear skies of opportunity are now clouded with doubt. The question on everyone's mind is this a temporary blip or a sign of a deeper, more structural shift? Are we witnessing a momentary pause or the beginning of a long-term trend? Understanding the motivations behind this investor exodus is crucial for navigating the future of global finance. It's essential to grasp the underlying causes to make informed decisions. This essay will delve into the key factors driving investors away from China, exploring both the external pressures and internal vulnerabilities that are reshaping the investment landscape. By examining these elements, we aim to provide a comprehensive understanding of the current crisis of confidence and its implications for the future. One of the most significant contributors to the decline in investor confidence is the ongoing trade war between China and the United States. Initiated in 2018, this tit-for-tat exchange of tariffs has injected a significant degree of uncertainty into the global economy. The tariffs, essentially taxes on imported goods, have disrupted supply chains and increased costs for businesses operating in both countries. For investors, this translates into reduced profitability and increased risk, making China a less attractive investment destination. The unpredictable nature of the trade war further exacerbates these concerns, as any escalation can have ripple effects throughout the global economy. Beyond the external pressures of the trade war, China is also grappling with internal economic challenges that are raising red flags for investors. After decades of breakneck growth fueled by investment and exports, the Chinese economy is showing signs of slowing down. One of the most pressing concerns is the country's mounting debt levels. Years of easy credit have led to a buildup of debt, particularly in the corporate sector. This raises concerns about the sustainability of China's growth model and the potential for a financial crisis. Adding to the anxieties is the Chinese government's crackdown on various sectors, from technology to education. While framed as measures to curb monopolistic practices and promote social good, these interventions have created uncertainty about the future regulatory landscape, making investors wary. The consequences of these combined pressures are evident in the cold, hard data. The numbers don't lie, and they reveal a stark reality for China's financial landscape. Foreign direct investment into China, a key indicator of investor confidence, has been on a downward trend. This decline is a clear signal that global investors are losing faith in the stability and profitability of the Chinese market. According to, cite a specific source and data point here, for example UNCTAD data, FDI inflows into China, describe the specific trend, for example, decreased by X% in 2024. This significant drop highlights the growing concerns among international investors about the future of China's economy. This exodus is not limited to FDI. The ripple effects are being felt across various financial sectors. Global investors are also pulling out of Chinese stock and bond markets. The withdrawal from these markets further underscores the lack of confidence in China's economic prospects. For instance, mention a specific example. For example, the Shanghai Composite Index experienced significant outflows in specific period, indicating a loss of confidence among foreign investors. This trend is a clear indication that the perceived risks are outweighing potential rewards. These figures paint a clear picture. Global investors are becoming increasingly risk-averse when it comes to China. The data speaks volumes about the shifting sentiment in the international investment community. The combination of trade tensions, economic uncertainties, and regulatory crackdowns has created a perfect storm, leading to a flight to perceived safety. Investors are seeking more stable and predictable environments for their capital, leaving China in search of greener pastures. As investors pull back from China, they are shifting their capital towards assets perceived as safer and more stable. This flight to safety is a classic market response to uncertainty, as investors prioritize capital preservation over potential high returns. One clear beneficiary of this trend is the bond market, particularly U.S. Treasury bonds, which are considered among the safest assets globally. Investors are flocking to these bonds, driving down yields and highlighting the strong demand for stability in the current climate. Despite the broader trend of investor caution, certain sectors within China continue to hold promise and attract foreign capital. These pockets of opportunity tend to be in industries aligned with China's long-term development goals, or those less susceptible to the vagaries of trade tensions and geopolitical maneuvering. One such area is renewable energy. China's commitment to transitioning to a greener economy and its ambitious targets for renewable energy development make this sector particularly attractive. Investors are recognizing the long-term growth potential and are pouring capital into solar, wind, and other renewable energy projects. Another area of interest is healthcare. China's aging population and rising incomes are driving demand for high-quality healthcare services and products. This creates a substantial market opportunity for both domestic and foreign investors, particularly in areas like pharmaceuticals, medical devices, and senior care. The current investment landscape presents a complex dilemma. On the one hand, the risks associated with investing in China are undeniable. Trade tensions, economic uncertainties, and regulatory interventions are all factors that can negatively impact investment returns. On the other hand, China remains a significant player in the global economy, with a vast consumer market and a growing middle class. The potential rewards for those willing to navigate the complexities and take on the risks are still significant. The key for investors is to strike a balance. This means carefully assessing the risks associated with specific investments and focusing on sectors with strong long-term fundamentals and less exposure to geopolitical and macroeconomic headwinds. While the current pullback is undoubtedly significant, it's essential to view it within the broader context of China's economic trajectory. China remains committed to its long-term goal of becoming a high-income, technologically advanced economy. Achieving this vision will require structural reforms and a shift away from the investment-heavy, export-oriented model that has driven growth in the past. This transition will likely involve a period of slower growth and continued economic rebalancing, which could further test investor patience. However, those who take a long-term perspective recognize that China's economic transformation presents both challenges and opportunities. As the country continues to evolve, new industries will emerge, and innovative companies will rise to prominence, creating new avenues for potential investment growth. The current pullback of global investors from China marks a potential turning point in the global investment landscape. This shift is not just a fleeting moment, but could signify a more profound change in how and where capital is allocated on a global scale. Years of unbridled optimism are giving way to a more cautious and discerning approach, as investors grapple with the complexities of a changing China. The once seemingly unstoppable economic engine is now facing headwinds that are causing investors to rethink their strategies and reassess their risk tolerance. The combination of external pressures such as the trade war and internal challenges such as economic uncertainties and regulatory interventions has created a climate of uncertainty that is making investors think twice. These factors are not only affecting short-term market movements, but also long-term investment decisions. While the future remains uncertain, one thing is clear: the days of easy money in China are over. Investors can no longer rely on the rapid growth and minimal regulatory hurdles that once characterized the Chinese market. Investors seeking to capitalize on the vast potential of the Chinese market must be prepared for a bumpier ride and adopt a more nuanced and strategic approach. This means conducting thorough due diligence, understanding the local regulatory environment, and being ready to pivot strategies as conditions change. Those who can successfully navigate these choppy waters and identify the diamonds in the rough will be best positioned to reap the rewards of investing in the world's next economic superpower. The key will be resilience, adaptability, and a deep understanding of the evolving market dynamics.